Well, good morning, everyone. Thank you for attending our second ever mortgage webinar. We do seminars at the branches all the time, but this is the second time we've experimented with doing an online webinar. So we really appreciate your attendance, and I thank you for being here. So let me introduce myself. My name is Dan Felix. I'm the Assistant Vice President of Mortgage Lending here at FAIRWINDS Credit Union. I work at our support center here in East Orlando, right off of Alafaya Trail. And with me today, I also have a guest with us. His name is Jacob Zambella, and he's from Prestige Property Shop. He will be our realtor guest today, and you'll be hearing from him in about 20-25 minutes. The whole webinar will be about an hour. And I want to let you know that this is more of a dialogue. So if you have any questions whatsoever, feel free to chime in. Before you should see a chat box. And in that chat box, you should see a way to deliver messages to us. So if you have anything you want to say or you have any questions, feel free to put it in your chat box. I want to let you know that questions will be primarily answered at the end of the webinar during a question and answer session. But feel free to put it in right away. No need to wait till the very end to ask a question. And the questions are private, so only I will see it. And when I answer them at the end, I'll repeat the question so everyone knows what I'm answering. So I want to get started here this morning by letting you know a little bit about my story and why I'm so big on doing these in-person seminars as well as these online webinars to educate the public. First of all, as a credit union, we have a passion to be financial advocates for our membership. So that means not only doing your mortgage, but actually educating you and teaching you how to make wise decisions about the mortgage products you choose. And so that's our mission in doing these things. And for me, this hits home personally, because I remember the days when I was a first-time home buyer. Seems like forever ago now, but I remember when I was a first-time home buyer, the pains that I went through because I didn't know the mortgage process. I didn't know what I should expect. And as a result, my experience was tremendously horrible. I remember being kind of thrown around by my lender. He's requesting things from me over and over again that I've already provided. And a transaction that should take about 30 to 45 days to complete took nearly 100 days. And it was a complete debacle. It was a complete mess. And then that was around the same time that I actually got into banking for myself. And then shortly thereafter, I got into mortgages myself. And I always told myself that if I ever had the opportunity, I would make sure that my borrowers faced a really different experience, a much better experience than what happened to me about 12 years ago. So without further ado, let's go ahead and jump right in. And I want to start off today by telling you what we are going to be discussing here on the webinar. So we're going to be discussing several things. The first thing we're going to be discussing is buying versus renting. So I want to tell you the difference between what your financial responsibilities are between those two things. And because I'm not of the mindset that everyone should be a buyer. We were of that mindset about 12 years ago, and lo and behold, we went through a financial recession where real estate was hit tremendously hard. So I want to talk through that with you. Then we're going to go on and talk about credit. I'm going to say a lot about credit. There's a lot of misunderstandings about what plays into your FICO score. And so I hope to clear up any questions that you have regarding that realm of the mortgage process. Then thirdly, we're going to talk about finding a home. And that's where my buddy Jacob here is going to talk to you. He's going to talk to you about the market. He's going to talk to you about what to expect while buying a home, going under contract. And he's even going to tell you how you can save a bunch of money with our Home Advantage program. And then lastly, we're going to talk about financing options. This is the more technical part of our webinar, and this will be the real nuts and bolts of different mortgage terms, different mortgage products, and how you can choose the best one that fits your needs. So moving on to our very first topic of the day, and that is renting versus buying. When renting versus buying, the first thing I like to share with people is that the biggest difference is in your monthly payments. All right. Not that the amount of your monthly payment is altogether different. In fact, a lot of times you actually save money by buying a house. The average rent in Orlando right now for a 3-bedroom house is somewhere around $1,700, depending on which study you look at. And so if you buy a home for, say, about $225,000, you can probably get a mortgage payment under that. So in a lot of cases, people who choose to buy a house will actually save money versus renting. But with that said, there is a difference in what goes into your mortgage payment. So for example, excuse me one moment. So for example, when you make a mortgage payment, the good news is that you're making payment into the equity of the home, meaning that yes, while you're paying back the lender the money that you borrowed, you pay down the principal of your loan, which means you own more and more of that house each time you make a payment. As opposed to when you make your rent payment, you're basically paying the landlord and you're not getting anything out of it other than a place to stay till the very next month when your next rent payment is due. So let's talk about equity, which is the next bullet point there. Equity, I like to define, is the amount of the home that you actually own. So for example, let's say your home is worth $100,000, but you owe the bank $80,000. Well, then you have 20% equity in that home. So basically in the beginning of owning a home, you have very little equity because typically first-time home buyers put very little down as a down payment. And so you might own, a bedroom or a kitchen, and the lender owns the other part of the home. But with mortgage payments, every time you make a payment, your equity increases because you're paying down that bank note more and more and more. And so it's a great feeling to know that as you make payments, it doesn't just go to your landlord and you get nothing out of it. You're getting equity out of a home. Also, another way to get equity from a home is when the market appreciates. For example, a home that sold in 2011 for about $200,000 is currently worth today in 2019 about $375,000. The market has nearly doubled home values in just the last 8 years. And so think about all that money that you're getting in equity. But I know you're probably thinking to yourself at this point, well, who cares about equity? What can I do with equity? It's not real money, right? Well, there's a couple different things you could do with equity. The first thing you can do is when you sell your house, and let's say your house is now worth $400,000 and you only owe $200,000, guess who gets to keep that $200,000 difference? Well, you do. That's much different than when you move out of the house you're renting. When you move out of the house you're renting, do you get any money out of it? Probably not. At most, you get your security deposit back, but that's about it. And so it is really beneficial to have equity in a home when you sell it, because that's all that money that you get to keep for yourself to either invest or put into a new home as a bigger down payment to buy a bigger home, maybe to upgrade. And so it's a really cool thing. Also, something you could do with equity is you could take out what's called a home equity line of credit. And so therefore you can use that money, the equity that you have in your house, to buy things. Let's say you need a new roof. Well, you take out a home equity line of credit. Let's say you want to finance your child's college education. Well, you can take out a home equity line of credit and borrow against the equity of your home. That's something that you wouldn't have available to you as a renter. And also, my next bullet point says landlord, because one of the really cool things that I experienced of being a first-time home buyer is that I got to be, you get to be the king or queen of your own castle. No one gets to tell you what you can do with your home anymore. I remember a quick little story that with the first time I rented a house, the landlord put all sorts of restrictions on me as to what I could do about decorating the home. And I remember hating that. And I remember thinking, I can't wait to own my first home because I won't have those same restrictions. And so those are all really positive things that should encourage you into home ownership. So with that said, let me give you the other side of the story. Let me share with you the next 3 bullet points that maybe are more reasons that you should consider renting if you're not in a financial position to buy. The first thing is repairs. So one of the nice things about having a landlord, and there's not a lot of them, but one of the nice things is if something breaks, you have a person to call. You have a person that is obligated by your lease agreement to fix the problem that you're having with the house. Well, as a homeowner, you don't have that luxury. As a homeowner, when something breaks, you have to fix it. And that can be costly. And so I always tell people, if you have an emergency fund set up, that's a great thing for home ownership. But if you don't have an emergency fund, if you cannot handle, for example, a $500 or $1,000 repair to your home, maybe you're not a great candidate to buy a house right now. Because the one thing I can assure you of is that things will break. You will be forced to make repairs to your house. And you don't want to be in a position where the only way you can make that happen is to get into credit card debt. Secondly, upfront costs. So buying a home has a lot more upfront costs than renting a home. Renting a home, some of the typical upfront costs you face is you have your first month's rent. Sometimes they ask you for your last month's rent. Sometimes they ask you for a security deposit. And if you have pets, maybe a pet deposit. And even though those things can add up quite quickly, I will tell you that it pales in comparison to the upfront costs that you have as a homeowner. Because as a homeowner, you have your down payment, which can be as little as 3%, but still significant. You have your closing cost. You have your escrows, which are like taxes and insurance that you have to buy on the home. And you have other prepaids that are optional. We'll get into a breakdown of what all those entail later on in the webinar. But the point that I want you to take right now at this point is that the upfront costs are definitely more significant when buying a home than renting a home. And then lastly is the insurance. So as a renter, your landlord might require you to buy renter's insurance. And that's generally cheaper than the insurance you would buy as a homeowner. And the reason is because as a renter, what are you insuring? You are simply insuring the contents of your home. Or as in a homeowner, not only are you insuring the contents of your home, but you're also trying to insure the dwelling. So like the walls, the roof, the structure, everything about the home. So it could be significantly more costly to get insurance as a homeowner as opposed to a renter. And then I have a last bullet point in there that just says other expenses. And that is because something that you need to be aware of is that living in the state of Florida, most homes come with what's called a homeowners association. So we refer to that as an HOA. And there's usually an additional fee to the homeowner to live in a community that has an HOA. We'll talk a little bit more about that later on as well. Okay, so now in this slide, I want to talk to you about credit. Credit is extremely important in managing when going through the mortgage process. Credit is something that you should be aware of before you even apply for a mortgage. It's a way that a lender can predict with not 100% certainty, but with some kind of indication of how you're going to pay back their loan. So the best way that we have to understand of your chances of paying back the loan is by how you've paid other loans in your past. That's why credit matters so much to a mortgage underwriter when they're trying to get you approved for a mortgage. So if you want to know about your credit before you even apply for a mortgage, I would highly encourage you to visit the website that's right here on the slide. It's annualcreditreport.com. Annualcreditreport.com is the only federally sanctioned website to get a free copy of your credit score and report every year. Now, I should throw out a disclaimer that you get your report for free every year, but you do not get your score. They want to charge you to get your score. I think it's something like $7.99. However, I also want to let you know that if you're a FAIRWINDS member, the good news is we probably already have a soft pull of your credit score already. So if you visit a branch, you can ask the teller behind the line, or you can ask one of the managers what your credit score is, and they might be able to tell you. So you can get it for free without having to pay for it at annualcreditreport.com. But at annualcreditreport.com, you get a free copy of your report, which consists of Equifax, Experian, and TransUnion. And that's pretty cool, because what you can do is you can pull your reports and you can see if there's anything reporting derogatory that you didn't know about, so that before you actually take the leap and apply for a mortgage, you have time to correct anything that might be misreporting or any derogatories that you weren't aware of. And so the nice thing is, you could print out those reports and you can go into a local FAIRWINDS branch and you can have them take a look at it for you. Because I don't expect you to understand everything that's on the report if you're not in the financial industry yourself. Therefore, have an expert take a look at it for free. And they'll counsel you as to what you need to get done regarding your credit history, if you need to get anything done at all. And so it's a good way to educate yourself before you start the mortgage process. Because if you have bad credit and you apply for a mortgage, by that time, it's too late to do anything about it. So I highly encourage you to fix your credit before you apply for a mortgage. Now, let me tell you a little bit about what goes into your credit score. A lot of people, when I do these seminars in person at the branch, and I always ask the question, what makes up your credit score? And surprisingly, although it shouldn't surprise me by now, but I get a lot of wrong responses to this. People think their income has a part in playing their credit score. No, the credit bureaus actually have no idea how much income you make. People also think that in order to have a good credit score, you have to have a credit card and carry a balance from month to month. That's also untrue. So let me tell you what is true. There's a few things that make up your credit score that you need to know about. So the most important thing, the thing that consists of 35% of your credit score, is making on-time payments. So basically, pay your bills on time. If you pay your bills on time, you're on the path to having a pretty good credit score. It makes up 35% of what makes up your FICO score. And by paying bills on time, the definition of that is not being late by more than 30 days. So once you pay a bill and it's more than 30 days past due, your creditor has an obligation to report you to the 3 major credit bureaus. And you will be reported as late, and that late payment, a single late payment, can hit you as hard as 70 to 80 points on your credit score. Yeah, let that soak in. 70 to 80 points on your credit score, depending on what your current FICO score is. And so the big takeaway there is make sure you pay your bills on time. All right, let me give you the second biggest thing that makes up your credit score. The second biggest thing that makes up your credit score is what's called your capacity, or other people refer to it as revolving ratio. So let me give you an example of what this is. Let's say you have 3 credit cards, and the total credit limits on the 3 credit cards combine to, say, $10,000 in total credit card limits. The key here is that you never want to use more than 30% of your credit limits. So if you have a combined credit limits on those 3 cards of $10,000, guess what? You never want to use more than $3,000 combined on those cards. Now, people ask all the time, well, what if I pay my card off in full every month? It doesn't matter. Do not use more than 30% of the balance or of the limit of your credit card. So if you have a credit card that has a limit of $1,000, don't ever use more than $300 on it. If you use less than 30% of the capacity of your credit card, you will be in very good shape. So think about what we have just talked about so far. Paying your bills on time is 35% of your credit score. And then using less than 30% of your credit capacity is another 30%. So those two things alone make up 65% of your credit score, and they're totally within your control to pay your bills on time and to not overuse your credit cards. So that's really a wonderful thing. And so I want to encourage you to do those two things. And if you do those two things, I assure you, you're going to have a pretty good credit score. So there's some other things that make up the other 35% of your credit score that we haven't talked about yet, but those are each much smaller. Those are things like every time someone pulls your credit, you get a little bit of a credit hit. It's usually about 3 to 5 points, and it's only temporary. Also, the length of credit history. Basically, the longer you have accounts, the better. That's why we usually encourage people not to close out credit cards, because the longer you have them, actually, the more it benefits you. With that said, if you're not using a credit card and you're just being charged annual fees, go ahead and close out those. But if you have a credit card that you're not using, I would encourage you to leave it open if you're not being charged annual fees, because the longer you have that open, the more it helps your credit. So, but the big takeaway here is pay your bills on time and don't overuse your credit cards. And by not overusing your credit cards, I mean 30% of your limits, and you'll be in pretty good shape. And so I think it also would be good to point out at this point in this discussion that your credit really affects a lot more than just your loan applications. Your credit now affects all areas of your life. Do you know that most employers, especially within the financial sector, now pull your credit before they even interview you? I could tell you that's true of FAIRWINDS. Did you know that your insurance companies, auto insurance especially, when you go to apply for auto insurance, that in most states it's legal to pull your credit, and that can help derive your premium? I forget what state it was, but there was a recent study done, and in one state it came to light that people with bad credit were actually paying higher auto insurance premiums than people who had a DUI on their record. Yeah, credit is that important, so take good care of it. So now what I'd like to do is talk to you a little bit about how credit matters, why it matters. So in this slide right here, oops, sorry about that. In this slide right here, we have an example of somebody who has a really good credit score, all right, 750 FICO. And because of their really good score, they qualify for a rate that is much better than someone with a 650 score. The person with a 650 score might qualify for a rate of probably about a half a point higher than the person with a good credit score of 750. All right. So they're going to save money on their monthly payment. They're going to save money on their monthly PMI. PMI stands for private mortgage insurance, and we'll talk more about what PMI does for you later on. And so their total mortgage payment is going to be far less than the person who has a score of, say, 650. And over the course of 30 years, that's going to equal to a savings of over $52,000. Think about that. You have two people who have the same exact mortgage. The only difference between the two people is that one has a 650 score and one has a 750 score. And the person with a 750 score will actually save $52,000 on their mortgage compared to the other person with a 650 score, only because their score is higher. So does credit matter when you're applying for a mortgage? Absolutely. One, it matters because if you don't have decent credit, you won't even get approved for a mortgage in the first place. And secondly, it will matter as to how much you have to pay back your lender over the course of your term. So I hope you got some good understanding of how credit works. And I now want to move on to something we refer to as debt to income ratio. So if credit will impact whether or not you get approved for a loan, this next topic, debt to income ratio, will determine how much you get approved. So let me repeat that. Credit determines if you get approved, and your debt to income ratio determines how much you get approved for. So your debt to income ratio is simply this. It's a simple way in which mortgage underwriters calculate how much you can afford to repay. And all they do is they take your total income and divide that by your total debt. And that gives us a percentage. And that percentage lets us know how much room you have to make a mortgage, to make a reasonable mortgage payment without completely maxing out your budget. Okay? And so really good practice for you to do if you're thinking about buying a house and getting a mortgage is to visit a local FAIRWINDS branch and ask them to do a quick pre-qualification with you. And what they'll do with the pre-qualification is they'll pull out a spreadsheet. They'll ask you questions about what debt you have in your life and about what kind of mortgage you're looking to get. And by answering those questions, they'll be able to figure out a rough estimate of what your debt to income ratio is. And it's a good practice and exercise to go through with the branch because it'll already start getting you prepared for what your price range is going to be when you look for homes with your realtor. And it's really important to know your price range. It's really important to know that, hey, when I go out with Jacob, my realtor, and look for homes, I don't want to waste my time looking for homes that are $400,000 in price when all I will qualify for is something in the $200,000 price range. So it's really important that you know your budget. It's really important that you have a good grasp of your credit, and really important that you sit down with a loan officer at a branch to determine your debt to income ratio. And once again, you can go visit any FAIRWINDS branch and they'll sit down with you and consult you for free and help you think through these things. Very important to get yourself prepared for a mortgage before you even apply. So now that we've gone through the high-level overview of credit and debt to income ratio, I'm going to turn the mic over to Jacob Zampella. As I said earlier, he works for Prestige Property Shops, and he is our guest realtor here for this webinar, and he's going to tell you all about buying a home and what you need to know. Jacob.
Hi. Thank you, Dan. So purchasing a home is going to be the biggest financial investment that you will ever make. And the role of the realtor is to kind of guide you through the process. There are many steps in the process, and with each step are potential problems. If your AC breaks or you have a leak in your pipe, your car breaks down, you always go to the expert. And so as a realtor, we're there to help resolve any problems that may come up in the real estate process. I always love the quote, "You don't know what you don't know." And so that's what we're there for. So once you go through the approval process, one of the things that I like to do is set up a consultation. And so what does that mean? I like to do a little one-on-one with you. We go meet at a Starbucks or a Panera, and it's a way for us to get to know one another. I can kind of get to know what it is that your wants, your needs are, and I can share a little bit about myself, get to know what you're wanting, and also be able to set the expectation. I'm big on expectation. This process is all about you, and I want to make sure that at the end of the process, you're happy. And so once we're able to figure out all the wants and needs, we set up the search criteria, a custom search just for you. We then figure out which homes that you're interested in, and we begin to go and look at some different listings. We go in the home. So some of the things that I do behind the scenes is I'm researching different comparables for the market. on that home. I am looking and checking in with the listing agent, asking if there's any offers on the table, any other interested parties, and finding out anything I can before we even go to the showing. Because I try to anticipate what it is, the questions that you're going to have before you even ask me, so I'm ready. So as we're walking through the home, there's going to be at least 4 main points of the home that I'm going to be looking for. And this actually just happened to me a couple months ago as an example. Walking through the home, I looked at the electrical panel and noticed that the brand name was one that has been known to cause fire. And what we were able to do, because the buyer was interested, is negotiate in the contract for the seller to replace the panel before closing. So that's one of the things that having a realtor is important for you to have while you're in the process of purchasing a home. Again, you don't know what you don't know. And this is going to be one of the biggest financial purchases you will ever make.
Thanks, Jacob. So one of the things that I really appreciate about using a realtor on a transaction is that it's free consultation for you. You don't pay, as the buyer, you don't pay the realtor. The seller has to pay the realtor. And so it's like someone working for you for free, someone who knows the industry in and out, and somebody who is going to protect you. We've done a lot of business with Jacob, and I highly recommend them. And at the end, we'll post his contact information so that you guys all have it if you are in the need to talk to a realtor and you want to get with Jacob afterwards. Thank you, Jacob. I appreciate that. One of the cool things about Jacob, too, is that he works with a special program called Home Advantage. And in the Home Advantage program, he actually will give up 20% of his commission to you to put towards your closing costs or to buy a fridge if you want, whatever you want to do with it. And so basically, think about that. Let's say you buy a home for, I don't know, $220,000. If you buy a home for $220,000, 20% of his commission is probably about between $1,200 and $1,500. Think about what you can do with $1,200 to $1,500 extra that you weren't counting on. I mean, that's a pretty big deal. So I would highly recommend our realtors in the Home Advantage program. And I really like Jacob. We've done a lot of business with him. So now we're going to move on to the final part of our webinar. And that is where we start talking about specific programs that we have here at FAIRWINDS. And after we're done with this last section, I will then answer the several questions that you have posted so far for me through the chat section. Thank you for those questions, by the way. So I want to talk to you about my first home savings account. This is a special account that we have created here at FAIRWINDS. Only FAIRWINDS has it, and we've created it just for first-time home buyers. We realize that the number one obstacle for a first-time home buyer is your down payment. It's not credit. It's not employment. It's not income. It's literally having enough cash to close on the transaction. And so as a result with that, not only do we have Jacob giving you part of his commission, but if you save with us for 12 straight months in our My Home Savings Account program, we will give you an additional $1,500 towards your closing costs. That's free money. Now, the only thing is you got to save with us for 12 months. So it's not for the person who's looking to buy tomorrow or next month. It is a long-term savings program of at least 12 months. But if you save a minimum of $100 for 12 straight months, we will give you $1,500 towards closing. The only caveat, the only catch you want to say is that you have to finance through us. But if you finance through us, hey, free $1,500. And so think about it. If you put $100 a month aside into this account for 12 straight months, you've met the criteria of the program. You saved $1,200 by yourself, and we're giving you an additional $1,500 on top of that. That's a savings rate of over 100%. Where do you know that you can get a savings rate of over 100% anywhere? Nowhere except for FAIRWINDS. And so we highly encourage you to save for us if you're thinking about buying a home within the next 12 months. So let me talk to you real quick, recap the savings that we have to provide you by doing a mortgage here at FAIRWINDS. And I'm not trying to sell you on FAIRWINDS per se. I just want you to understand all the resources we're able to provide you by doing a mortgage here. So first, you have the Home Advantage rebate through my buddy Jacob here. Let's say that's about $1,280 that you get based on a home of about $220,000. Then you save through us, so you get the My First Home Savings rebate, $1,500. The third thing on that slide is we waive your intangible tax. Because we're a nonprofit institution, we are not required to pay intangible tax on mortgages. That's a one-time tax you have to pay at closing anytime you finance a home with a mortgage. But if you go through us, we give you our tax exemption status so that you don't have to pay that. And on a home of about $220,000, it's going to save you about $425. Not only that, but by attending this webinar, we will give you a free appraisal. An appraisal costs about $450. But the good news is that when you're ready to apply, if you tell your loan officer that you attended either a webinar or an in-person seminar, they will waive the appraisal fee for you. So you add up all of those savings, and it's another $3,600 coming your way for doing your mortgage here at FAIRWINDS. So think about it. Even if you don't have a dime saved up towards your mortgage transaction, just by going through FAIRWINDS, you already have about $3,600 coming your way before you even save your first dollar. And so that's one of the things that we're able to do as a credit union, being a nonprofit institution. So I highly encourage you to either do the financing with us or do the financing with another credit union if you're already a member of that credit union. We're all a family. So the big $1 million question here is, how much will I need? Well, the good news is it's not $1 million. But I do want to break down to you the cost that you will be able to anticipate at the closing table when it's time to buy your house. So the first thing you have to account for is your down payment. If you're buying a house for the first time, you need to save up a minimum of 3% down payment. If you're not a first-time home buyer, and the definition of a first-time home buyer is someone who has owned a home within the last 36 months. So if you're not a first-time home buyer, the minimum for you to put down is 5%. But if you are a first-time home buyer, you can get away with as little as 3%. And this is for a conventional loan at FAIRWINDS Credit Union. So on top of the 3% down payment, there's also closing costs. Closing costs are the fees that are charged to you by many people who are involved in closing your transaction. The title company has fees that they charge. The county has many fees that they charge to record the mortgage and to transfer the deed from one party to the next. And all these things make up your closing costs. And I generally tell people it's about 2% of your loan amount. That's not an exact science, but I'm just giving you an estimate right now. And then you also have something here called escrows. Escrows are money that you have to save up to pay for your taxes and your insurance every year, because homeowners insurance is required and the county is always going to want their taxes every year. And so we open an account called an escrow account, and we put money aside for you each year to pay those things, so you're not stressing about how you're going to come up with that payment every year. And we have an account set up for you that we will take directly out of it and pay your taxes and insurance every year. To set up the escrow account, it's usually somewhere around 1.5%. So between 3% down payment, 2% closing costs, 1.5% escrow, we've talked about 6.5%. So just some basic math here. Let's say you're buying a house for $225,000. And I just told you you have to bring about 6.5% to closing. Well, that's about $14,625. That's a huge number, right? Well, don't let that number stress you out, because remember, If you use all the programs we have here available to you, we're going to give you about $3,600 of that. So you subtract $3,600 from that number, you're down to about $11,000. And $11,000 might still seem like a big number to you. Well, the good news is we have programs here at FAIRWINDS that will help you pay for your closing costs. Now, the trade-off there is that there is a higher interest rate if we pay your closing costs, but if you need the cash because you don't have it yourself, we will pay for your closing costs. And so therefore, you could have far less to bring to the closing table. So we can get you into a house of $225,000 for probably out of pocket of, say, closer to about $7,000 or $8,000 saved up. Now, the last bullet point on that slide is a discount point. I haven't mentioned that yet in expenses because a discount point is an optional fee. You do not have to pay a discount point. So you might be thinking to yourself, okay, well, if it's an optional fee, why in the world would I want to pay an optional fee? And that is because a discount point lowers your interest rate. So I might tell you, Bob, guess what, Bob? Good news, you were approved for this mortgage and your interest rate based on your credit score is going to be 4%. And Bob might come back to me and say, well, I was really hoping that I'd only had to pay 3.75% as my interest rate. And I'll say, Bob, I'll give you whatever interest rate you want. But if you want to pay a lower interest rate than what you qualify for, you're going to have to pay for it. And that's what a discount point is. It's a fee. It's a one-time fee that you pay up front to get a lower interest rate than the interest rate you actually qualify for. So completely optional. So let's talk about some different loan options. The first question you're going to have to answer is, what kind of mortgage do you want? What kind of amortization you want? And what I mean by that is, do you want a fixed rate mortgage or do you want an adjustable rate mortgage, also known as an ARM? So a fixed rate mortgage is a mortgage which stays the same over 30 years or 15 years, whatever term you pick. And so the nice thing about a fixed rate mortgage is your interest rate will never change. And that gives you stability when you own a home and making your payments so that you don't have to stress about year to year your interest rate going up to a level in which you cannot afford the home anymore. I highly recommend a fixed rate mortgage for about 95% of the people out there who are ready to buy a home. Now, for the 5% of people that I recommend an adjustable rate mortgage, that's a mortgage in which your rate is fixed for a certain period and then adjusts every year after that. It's because they don't plan on being on the home very long. So for example, if somebody takes out a 10-1 ARM, what that simply means is that your mortgage rate is fixed for the first 10 years. And then after year 10, it'll adjust every single year after that, depending on what the market holds. So if you tell me, Dan, hey, I'm definitely moving in 7 years. I'm only going to keep this house for a couple of years. I'll say, okay, well, maybe an ARM is better for you because you'll have a lower initial interest rate and you're going to move or get rid of the mortgage before your adjustment period is up. For those people, I would recommend an ARM. But most people don't know when they're going to leave a house. Most people don't know when they're going to sell. Most people don't have a defined period of time in which they're going to be in the house. And for those people, that's why I always recommend a fixed interest rate mortgage. The next thing on the slide is length of loan. Typically speaking, first-time home buyers take out a 30-year mortgage. They take out a 30-year mortgage because they want the lowest payment possible. And that's perfectly acceptable. But here's what I want to challenge you with. When you go to apply for a mortgage, ask your loan officer, hey, how much would my payment be if it's a 15-year mortgage or a 20-year mortgage instead of a 30-year mortgage? And the reason why I challenge you to ask that is, yeah, the payment is going to be higher. But by paying off your loan 10 to 15 years sooner, you're going to save tens of thousands of dollars in interest payments over the life of that loan. And I can guarantee you this, in 15 years from now, if you took out a 15-year mortgage instead of a 30-year mortgage, you're not going to wish you took out a 30-year mortgage. And so I understand that it might be too hard to make that 15-year or 20-year payment. But hey, when you're ready to apply for a mortgage, it doesn't hurt to ask. As I mentioned earlier, we do have no closing cost mortgage options, and that is for anyone who wants it. However, the interest rate is 0.5% higher. So, for example, if you pay for your own closing costs, let's say your interest rate is 4%. But if you want us to pay for your closing costs, then your interest rate is 4.5% instead. So, in a perfect world, you would pay for your own closing costs because it is better for you to come out of pocket that extra money for your closing costs and take the lower interest rate. But with that said, many first-time home buyers do take us up on the option for us to pay the closing costs because they simply don't have the cash, and that's what it's there for. Also, I want to talk to you about several loan programs. FAIRWINDS currently offers conventional financing. That's mostly what we've talked about up until now. But I also want to mention that in just about a month or two, we are going to start offering FHA loans, which is a government loan. It's a little bit easier to qualify for. It's great for first-time home buyers with lower credit scores. If you have a really good credit score, what I mean by really good credit score, I mean 680 or higher, I would highly encourage you to apply for a conventional loan. However, if your credit score is below a 680, FHA lending might be a better option for you. And then also what we're going to be taking on here shortly, probably within the matter of 3 to 4 weeks, is VA loans. VA loans are specific loans who are specially geared to our military veterans. If you are on the call today and you're a military veteran, please make sure you ask about a VA loan option when you start applying for a mortgage. Those are tremendous loan options for you when buying a home. Okay. Earlier in the webinar, I alluded to something called PMI. Stands for Private Mortgage Insurance. PMI is a fee that you have to pay every month and is rolled into your monthly mortgage. Now, here's the good news about PMI. The good news about PMI is that if it didn't exist, everyone would be required to save up 20 to 30% as a down payment to buy your first home. What first-time home buyer has 20 to 30% down? Not many of us. And so in comes the PMI companies, private mortgage insurance companies. And what they do is they help lenders offset the risk of such a small down payment like 3%. And by doing so, it insures your loan against the situation in which you're not able to pay back the loan. Now, on the bad side, there is a premium to be paid for that. But on the good side is if it didn't exist, then you wouldn't have that opportunity to make such a low down payment when purchasing a home. Now, the really cool thing about PMI on a conventional loan is that it will go away after you reach about 80% loan to value. So one day you'll get your mortgage statement in the mail and you're going to be thinking to yourself, why the heck did my mortgage payment just go down? I thought my interest rate stayed the same. And the answer to that question is it did stay the same, but you are no longer required to have PMI on your loan and you're no longer required to pay the premiums because you now have enough equity in your home. And so on a conventional mortgage, one of the reasons why I always tell people apply for a conventional mortgage instead of an FHA loan if you can qualify for it is because the PMI will just magically go away one day. Whereas in an FHA loan, unfortunately, the FHA loans will have PMI for life, meaning that you'll have to pay PMI for, if you take a 30-year mortgage, you'll have to pay PMI for all 30 years. So that's what is one of the things that gives conventional loans, makes them superior to FHA loans, that over the course of your 30 years, it's much cheaper to have a conventional loan because the PMI will drop off. A really cool program that we have for first-time home buyers here is a program called Home Ready by Fannie Mae. The Home Ready program was specifically geared to people who want to put down as little as 3% and are in the lower income bracket tiers. So if you're on the call today and you have maybe a lower on the income scale, Well, the good news for you is that you may qualify for this program. And qualifying for this program, what it does is it subsidizes your mortgage interest rate as well as your PMI payments. So your mortgage loan your monthly mortgage loan that you pay back will be lower than someone not in the Home Ready program because you'll have a lower interest rate and your PMI premium is less. This is something that we can get into more when you're ready to apply for a mortgage, and you can talk to your loan officer about the Home Ready program if you qualify for it. It is income restricted. Lastly, what I want to do here today is show you an example of what makes up your monthly payments. Because by now, you've probably gathered your monthly mortgage payment doesn't just include your monthly mortgage, but includes other things as well. So in this example, someone bought a home for about $225,000 and they put 3% down and their monthly mortgage is $1,606. Now, what makes up that payment? Well, most of it, about $1,146 of that, is your actual mortgage payment, the amount that you're paying back to the lender in principal and interest. The next expense is PMI. In this example, we're collecting about $80 a month for your PMI insurance premium. Then you have property taxes. The county is going to charge you property taxes every year, and we collect that on a monthly basis so that when it's due every November, you have enough money to pay that bill. In this example, the monthly amount that we're collecting for property taxes is $235. Then there's homeowners insurance. Yes, you are required to have insurance on your home if you own a home with mortgage financing. And in this example, it's about $120 a month in premiums. Now, the last thing I have on here is HOA fees. In this example, it's about $25. I do want to be clear about the fact that we do not actually collect HOA fees as part of your mortgage payment. We collect all the other things, your principal and interest, your mortgage insurance, your property taxes, and homeowners insurance. HOAs, you actually pay directly to your homeowners association. But I put it in this example so that you understand that you should consider the amount of your HOA when budgeting for a mortgage. This is really important because HOA fees can swing wildly depending on which house you buy. In some communities, the HOA fee is as low as $15, $20 a month. Both homes that I own are in communities like this. They don't come with many amenities. I don't have basketball courts, tennis courts. I don't have a community pool or anything like that. It's real basic, so it's really cheap. But the more you buy into a community that offers more amenities, the higher HOA fee is. So as you're shopping around with Jacob or whatever realtor you have taking you out to see homes, you want to keep that in the back of your mind. You always want to ask the question, what's the HOA fee in this community? So that you could budget as needed. So finally, the last slide that I have for you today is just next steps. Where to go from here? You'll want to meet with a loan officer at a branch. You'll want to talk to them. You want to go to annualcreditreport.com, print out those credit reports, bring it into a branch, talk to your branch loan officer about your credit report, talk to them about your credit score, and talk to them about your debt to income ratio. You do those three things, you're putting yourself in a really good position to actually get yourself in the right position for a mortgage. Then, once you talk and discuss those three things with the loan officer, what you'll want to do is you'll want to get pre-approved. You'll have to put on a full, what we call credit application. That will then be handled by one of the mortgage loan officers on my team, and we'll get you an official pre-approval letter. You then take that pre-approval letter that we give you, and you hand it to your Home Advantage realtor. And then they will take you out shopping for a home in your price range. After you find a home you like, you make an offer. And if the seller accepts your offer, you go under contract. And then we have about 30 to 45 days from the day that you go under contract to process your loan and get that closed for you. And then at closing, you get your keys, and you get to be a homeowner. And that's the beautiful process of buying a home. So without further ado, if you have any questions, please type them in the text box you see there, and I will answer them in just a moment. So throughout the seminar, I did notice that we have gotten several questions from different people. And so I'm going to start answering those right now. The first question that we got was, do we get cheaper rates with our rewards? And so FAIRWINDS rates that we offer, we do not offer a discount on the rates. And so basically the rates that we offer are to the public and they're for everyone. And so no, having reward points here at FAIRWINDS does not get you cheaper rates on a mortgage. The other question I got was, for new construction homes, does that change how much you will get pre-approved for? So on new construction homes, you will get pre-approved typically through the lender of the builder as well as FAIRWINDS. A lot of builders require that you at least get pre-approved through them. If that's the case, that's fine. We have good competitive programs that can compete with the lenders. Now, that doesn't change how much you get pre-approved for. At the end of the day, whether you go new construction or you buy an existing single-family home, you still need to be able to qualify for the amount that you're applying for. Another question that we got today is, are there any loan programs for healthcare professionals? So I will be upfront with you and tell you that FAIRWINDS itself does not have any specific programs for healthcare professionals. But I would be remiss to tell you that, if I didn't tell you that there are programs out there. Certain of the larger institutions that do a lot of business with healthcare professionals do have what they call doctor loans or loans for people in the healthcare industry. So you're more than welcome to check those out. But also a lot of healthcare or hospitals have their own credit unions. And if you work at a big hospital and you have a credit union within your hospital, I would highly recommend that you check to see what special programs they might have for you. And compare that with the programs that we have, our regular programs that we have here at FAIRWINDS. Because even though people might have special programs for healthcare professionals, to be honest with you, our rates here at FAIRWINDS are so low, a lot of times we even beat those special programs. I got some questions from a few of you about Credit Karma. I imagine I got those questions when I was talking on the slides regarding websites to visit to get your credit history for free. So I highly recommend the website that I suggested to you, annualcreditreport.com. It's simply the best website. With that said, Credit Karma is free. They give you your credit score for free. I've used Credit Karma. However, I use Credit Karma for something a little bit different. If I want a free copy of my credit report, I go to annualcreditreport.com. However, if I want to get a feeling of what my score is like, I will go to Credit Karma because they'll give it to you for free. Now, please understand that Credit Karma doesn't have your true FICO score, but they have a similar algorithm that'll give you a pretty close measure of what your credit score is going to be like. Just don't take it as gospel. Also, a program that Credit Karma has that I really like is that they will monitor your credit for free. And so I've encouraged people to use that as well. So yes, I'm a big proponent of Credit Karma. But like I said, if I want my actual credit report for free, I would get it from annualcreditreport.com. So I think that answers most of the questions that we got. I'm going to give you guys another 10 or 15 seconds to type up any last questions before we end the call. I really appreciate everything that you guys have done here for us and being patient throughout this webinar and answering such good questions. I do have one last question here that I just got from somebody, and that question is, what's the minimum credit score on loans? So to answer that question, typically speaking, the minimum credit score is 620. Now, when we're getting into the low 600s, I do want to caution you that you might not qualify for a conventional loan. We might put you into an FHA loan instead. But if your credit score is at least 620 or higher and you're looking to buy a home, it is worth applying for a pre-approval and seeing if you can actually get a mortgage application to get a mortgage pre-approval. And so I think that wraps up all the questions that have been posted. Thanks again for those questions.